Okay, good morning everyone, and welcome back to MACROACE. I know I have been away. I was away last week because I was ill. Came down with a horrible flu. So apologies, I wasn't able to cover non-farm payrolls. I mean, I could try and do it when I'm ill, but yeah, that's not a good idea. So all right, so US CPI, very important report before we get the next round of the Fed minutes at the Fed decision, should I say, at the end of October. Expecting the CPI data to be lower than the previous figures all round, except the core month-on-month, which is expected to come in line with the previous at spot 3%. And of course, we have the initial jobless claims. But what we're going to do is going to go through the sentiment, what the release means, how it could affect the markets, and then what has the pricing in been, and what the triggers should be for the economic release. So let's get into it. So first of all, US CPI, what is it? It shows how much consumers are paying for retail goods and services, and it's what it does is it's measuring a monthly change between those, how much people are paying for goods and services. The way it's measured, you have 26,000 retail outlets, 4,000 housing units in 87 urban areas where prices are collected on 80,000 different goods and services. Yeah, no, you are completely right, Dragon. Sometimes flu gives us time to rest, and it did. But yeah, I'm all good now. So the key measurements then, how is the CPI report made up, and what's the most important part of the report? So housing represents about 42%, food and beverages about 14%, transportation 18%, and then medical care about 8.5%. And then, of course, you have the core data, which excludes food and energy, and that is something that's going to be quite interesting to see, of course, with the Saudis and Russians that had decided to extend their output cuts by another 3 months into November. And then also there was some news yesterday that Putin and Russia was having a discussion of maybe extending that deal further. But again, a little bit of speculation there, which is keeping the market quite hot within the oil market. And then you have the Israel conflict with Hamas that won't have an impact now on the CPI data, but it could potentially further down the line. So you have two bits of sentiment that are affecting the markets overall. With the OPEC plus, specifically with oil, but then you also have the Israeli-Hamas conflict that's had an provided an overall risk-off reaction to the markets. So bear in mind also tomorrow I did say I was going to do the part 2 of risk on, risk off. That's going to Monday instead, and I'll update you guys with the timings of that. So it's not tomorrow, it is on Monday. Okay, let's carry on. You usually have the seasonally adjusted data or the month-to-month figure that is preferred as to what's going on in the economy without the effects of weather and production cycles. But of course, in this instance, all the inflation figures matter because that's what the Federal Reserve is focused on. And if they do see a whiff of inflation ticking back up, then the speculation from the markets also rises with the expectation that the Federal Reserve may hold rates for longer, or they might deliver another hike depending on what central bankers say, or how the markets might feel too. So now the difference between PCE and CPI data. So the PCE inflation places a low weight on prices of gasoline and residential rents and focuses on the nation as a whole rather than just focusing on urban areas. Then how does it affect the markets with CPI? Very simple. If you see inflation ticking up, you see the dollar strengthening. One, in anticipation that the central bank is going to raise rates or continue to keep rates at a higher rates for longer, or that the economy is relatively healthy and there is a gradual increase in prices off of the back of more demand for goods and services within the nation. For the stock market, usually in this tightening environment, underlying inflation is the key bit, or the key metrics to be aware of. But usually, when you do get a CPI that is hotter than expected, again, it's going back to if the Federal Reserve sees, or if the markets think that the inflation report is too hot, then there's repricing that goes on where you see a depreciation in the stock indexes. And then of course, when the markets open, then everything else kind of falls into place, and then markets try to price in maybe a higher rate of interest rates from the Federal Reserve. So usually higher than expected read for inflation is bearish for the stock market, particularly focusing on the core data to kind of back that up. For the bond market, again, simple. If you get a high read of inflation, yields tick up in anticipation for rates being higher for longer, or rates going higher instead. And that will also have an effect on what the Federal Reserve does. We have had some comments in the past where Fed members have said that if borrowing rates are and the long-term rates are quite high or maybe overvalued, then maybe the Federal Reserve doesn't have to do that much more work with rates, and they can just let the market do the work for them in that instance, if there's been an overpricing of those bonds. So that's another thing to keep an eye out for in the background. So if you do get a strong inflation print, how much would it be moderated if the Federal Reserve is expecting yields to go higher because of the expectation that rates will stay higher for longer? Then the previous report that we'd seen in September, for the August report, the index for gasoline was the largest contributor to all items increase, accounting for over half of the increase. Also contributing to August's monthly increase was the continued advancement in the shelter index, which rose for the 40th consecutive month. Okay, where is the economy at the moment? So non-farm payrolls, like we had last week, came in stronger than expected, and also compared to the prior two at 336k compared to the prior of 227k. Unemployment rate remained unchanged at 3.8%. Average earnings slightly ticked down to 4.2%. Employment costs were at 1%. PC price data was at 3.5%, so slightly higher. And the core data, on the other hand, was slightly lower, 3.9%. The ISM manufacturing prices paid was at 43.8, so slightly way lower than the prior figure. Services prices paid was unchanged at 58.9. Productivity was up 3.5% compared to 3.7. Import and export prices, so you had import prices, both of them were higher than the previous figures. The PPI data that we had yesterday, PPI was higher than the prior at 2.2%, as was the core data. Now, there was a very short-lived reaction where you did see a short depreciation from the S&P 500 and an appreciation from the dollar off the back of that data. It still shows that the inflation prints are very important to keep an eye out for, but it also means that the markets could, if the figures don't see, remember the PPI data doesn't translate well to what consumers are going to be paying in the future. What I mean by that is that PPI prices take much longer to then be passed on to the consumers. Of course, businesses are not going to constantly change their prices for what consumers are going to pay every single month or here and there. They're going to try and keep it gradual and change those prices over a longer period of time. So one print of PPI isn't going to be enough to say, right, the Federal Reserve is going to keep raising rates. It's more or less, it's speculation that then grows that maybe if there are price pressures from the producer side of things, then that will eventually lead to consumer prices going higher, or maybe remaining stickier than what the Federal Reserve economist might be expecting, what the markets might be expecting too. So that's how you should take the PPI report, more of a long-term view of what could come along. But usually you need at least 3 months worth of PPI data, PPI reports consecutively going in one direction, whether it be up or down, to then begin talking about whether there would be a trend where prices for consumers will either rise or not, or start to decline. So just to make that kind of clear for people, if you were kind of confused, or if you were sure that PPI data was hotter than expected this month, then the Fed is going to continue raising rates or keep rates high for longer. More of a leading indicator in that way. So the triggers then for the economic release. Now let me bring on the deviations because, actually let me bring the range because I did update this earlier on today. So bring it here. Okay, I've got the ranges. See if I can show you. Okay, here we go. Okay, so here we are with the CPI year on year. So the forecast is for 3.6% with a range of 4% to 3.5%. CPI month on month with a range of 0.6% for a high estimate and a low estimate of minus 0.2%. The core CPI year-on-year data with a high estimate of 4.2% and a low of 4%. And then the CPI month-to-month, according to economists, they see a high estimate of 0.4% and a low of 0%. Now, what we've seen in the past is when data has been all in line, is if data has gone in one direction, i.e. higher or lower than the forecast, I mean all the bits of data, then you tend to get a stronger reaction. But if the deviation isn't that big, i.e. I'm talking about like a 0.1% deviation, then usually what happens is you get the initial reaction that happens, but then the market can reverse quicker than compared to a set of releases that have much bigger deviations of at least 0.2% for all of the figures. And that's because there is the expectation that, okay, if inflation is going out of hand, or the economists have wildly missed their estimates, that there is something wrong, and then, or maybe things have gone really, really well, then they were much better than what they were expected to be, then you get more volatility that creeps in, and hence you get bigger moves within the market. Doesn't always necessarily mean that, but you have more of a chance of that occurring. So let me bring this back there. I'll come back to the deviations sheet for next time. So if I just kind of skip through that, we've kind of gone through that there. So now investment sentiment and views. It's key to understand for future expectations, maybe not completely for what to expect for this upcoming economic release, but it's important to kind of understand what are investment banks feeling about inflation and the US economy, and then how would their comments be compared to what the Federal Reserve is thinking too. So that's how we should kind of think about these comments whenever I talk about them. So let's start off with BlackRock's Hildebrand. So BlackRock's Hildebrand said the interest rates are probably near their peak after an aggressive round of hikes, and we're going to be in a much stickier inflation environment, and rates will not be able to come down to respond to weakness. Then Morgan Stanley, they said that today's CPI print could paint a different picture, but the PPI data suggests that we haven't seen the end of sticky inflation and high interest rates. Either way, investors will need to remain patient, and it was one challenge getting it down to, as said, so lowering inflation significantly from last year's highs was one challenge, but getting it down to the Fed's 2% target is another level. So what they mean there is that it's easy to go from a high inflation with a strong rate hikes, okay, but then when you're trying to nudge inflation towards the 2% goal, it's more difficult because you're near the end of your tightening cycle, but you're not sure whether or not you need to do more tightening or keep the rates at where they are to then say, okay, we've done enough. So that's what they mean by that. So that's why the inflation print today is going to be quite important, because if you do see the data that's in line with expectation, you might get a mixed report. You might get a mixed reaction where markets, on the one hand, might take it as that inflation is slowing down, and you could see the stock indexes see an appreciation or a brief appreciation. Or on the other side, markets could take it that the economy isn't slowing down fast enough, and then you might see a depreciation from these stock indexes. So there are two ways that you could view how the inflation data could come out, or what the reaction could be like to data from the inflation report if it comes all in line with expectation. If the data is mixed, then it makes it harder to kind of define what the market is going to do, because they might be confused. You will then, in that case, might get more of a whipsaw reaction from the markets, trying to figure out what direction the Federal Reserve might be going, and also which direction they want to go, whether they view a mixed report as a positive or as a negative. So these are things that we've just got to be careful of. So that's why it's always nice to have a report that you have all the data that is higher or lower than the forecast than the forecast figures. Okay, so you either want all greens or all reds. And when I say all greens, you want data that's higher than expected, or all reds if data is lower than expected. Okay. So, and then BMO, they also weighed in too, saying that policymakers have begun to acknowledge a lesser need for further policy action, given financial conditions have tightened considerably after the recent surge in treasury yields. That's according to Ben Jeffrey at BMO. And they said that this acknowledgement may have reduced angst around the need for additional rate increases. So again, if you do see a slightly hotter than expected inflation print, you could still expect a bit of a bullish reaction from the dollar, but it might not last that long if there is sentiment that creeps in or is creeping in on the central bank members are noticing that higher rates already is doing or is helping the Federal Reserve do their job to get inflation back to the 2% target. So that's what they mean. Again, we've kind of got to wait for the data to come out, see how big of a deviation that there is. At least a 0.2% deviation on all of the figures of where you'd expect a stronger reaction. Let me go through the deviation now. I think I am done all there. So, no, actually, we've got some comments. So, Fed and government views. So, you had Fed's Logan said that higher yields may mean there's less need to raise rates. Fed's Daily said market odds for hikes in November and December don't look out of line, and we can hold rates steady if labor and prices keep cooling. Of course, with the labor print that we had last week, that wasn't the case. We'll see what the case is for today for CPI. Fed's Bostic said that I see one rate cut in 2024 near the end of the year. Mester says I am likely to favor a hike at the next meeting if current economic situation holds, i.e. that the data is still quite strong or stronger than what the central banks might expect. And Fed's Bowman said that it will likely be appropriate to raise rates further and hold them at restrictive levels for some time. Okay, and then market pricing. So on the 20th of September, Fed swaps priced in a higher peak of policy rate of 5.49% in January. Swaps show traders pushing back the first rate cut to September. And October 6th post the stronger than expected non-farm payrolls report. Fed swaps shift full pricing of rate cut to September from July. And swaps price in higher odds of a rate increase this year. So the CPI report, if it is stronger than expected, it will add to that speculation, and maybe it could push out the potential for a rate cut even further, depending on how strong the data is. But again, that would be short-term speculation until it's kind of backed up by some of the Fed members when comments come through from them, giving more clarity where they can about where they expect the first rate cut to be, or when they feel like the rates should be kept on hold instead. But as we know, the Federal Reserve has been wrong for ages, and they've been continually raising rates for much longer than they would have expected. So I think originally back about a year ago, I remember, I think we were around 3% for the federal funds rate, and SCP showed that the rate would peak at around 3.5% in 2023. Of course, we're way above that. I'll have a double check that later on, but from memory, yeah, inflation has continually made the Fed's job tougher and surprised them. So I wouldn't be surprised if they decide if this inflation rate is much stronger than what they expect, or what the markets expect, that the Federal Reserve decides to say, well, maybe we need one more rate hike to kind of cool things down. But they did say they don't mind skipping one hike and then doing a hike later if warranted. Okay, right. So let me get up the deviations then, and let's get that. Let's kind of go through what the last print was like. Let's just set up a part of my screen here. So whilst I'm setting this up, so I'd gone to my friend's wedding over the weekend. Somehow it was still live, but as a present, we were walking around in town, and there was this guy selling T-shirts of different celebrities like Michael Jackson, Biggie Smalls, Tupac, and I'd seen Tupac. I was like, maybe I should get him a T-shirt of Tupac as a wedding gift. So he opened up the gift. Maybe about a couple of days later, he was like, "What the heck is this? Why have you given me a T-shirt of Tupac with the date that he lived to the date that he died, and a picture of him just stood there, just putting up gang signs and stuff?" I was like, "Well, I thought he'd like it." Anyway, all right, we've got about 7 minutes. Let me get up the deviations. Oh, you got the similar thing too? Yeah, it's always good. It's better to give something memorable than something that's not going to be remembered. Okay, CPI. So the last time round, so here we go. So you can see here that when all the data wasn't going in one direction, then the market reaction was more muted. And don't forget if you like the video so far and you find the information useful, don't forget to subscribe to the channel, get the word out there, like the video, and yeah, show your support. But as said, so the last time around, the market reaction, the data wasn't going all in one direction. So you had the initial market reaction of the S&P or the stock indexes seeing a decline, but after 10 minutes of trading, they're already making their way back up towards pre-release levels. So then after about 30 minutes of trading is what this blue figure in blue bracket represents. Okay, 30 minutes of trading, the S&P was up by 1 tick. So let me just clarify what I'm showing you here. So this first figure here shows you the initial market reaction going to the wick of the candle, okay, on a 1 minute chart. The figure in the black brackets shows you the market reaction 10 minutes after the economic release, going to the end of the candle. And then here the blue brackets represents the market reaction 30 minutes after the release. Okay. Again, same thing, going to the wake of going to the end of the candle. So you can see here, yeah, when in the past though, when data has gone all in one direction, that the market reaction kind of held up a bit better. And you can see here with a 0.1 deviation that it's still it's not enough to kind of let the market have an uber big reaction, although the same direction is sustained. So you can see back on July 12th, you'd seen an initial 74 ticks towards the upside. After 10 minutes of trading, it was up by 90 ticks. And after about 30 minutes of trading, it was still around that 90. It was still up by around 90 to 88 ticks to 90 ticks. A similar thing with the NQ as well. and with the currencies. So yeah, so that's what we want. We want all data that is going in one direction to get a more of a sustained reaction, but to get an even stronger reaction, we'd want data that is seeing 0.2 deviation for all of the figures, okay, at least. There will be some instances where, okay, back in November 10th, this is, whilst the Federal Reserve was hiking, was in the midst of their hiking cycle, that inflation prints, the markets were very, very sensitive to the inflation prints. We see here where you'd seen, maybe 0.1 deviation or 0.2, but the NQ had seen, actually, I think that was its biggest reaction we recorded. No, it was the one below it. Yeah, where there was 1,520 tick move, 20 tick move that happened on the initial candle off of the inflation data. But you can see over time, as the Federal Reserve gets closer and closer towards its target, or towards the hiking cycle, the end of the hiking cycle, that the market reactions become smaller, and the data requirements, or what markets are looking for, is they're looking for bigger surprises. Initially, any inflation report with data seeing a bit of maybe seeing one bit of data up or down would kind of help the markets, or would be enough to kind of help the markets propel and go in one direction or decline. But now it's more nuanced. Now the markets are looking for bigger figures. So if we do get a scenario like this, a couple of bits of data are higher than expected or lower than expected, or it's mixed, then no, you're not. If it's, ignore the mixed bit. But if the data, if a couple of bits of data are higher than expected, but the rest aren't, they're coming in line with expectation, you get an initial reaction, but it won't last that long. That's why you want to look for all the data going in one direction, at least, to get a more of a sustained reaction. So you can see here what data was mixed. Even on the first candle, you can see back on June 13th, you had seen a whipsaw reaction of about 52 ticks down and then 48 ticks up on the first candle, okay, going wick to wick. And then after about 10 minutes of trading, it was about 13 ticks up. So mixed data, you want data going all in one direction. We've got 1 minute to go now, so let's go to the markets. Hopefully that kind of clarifies it. So we're looking at the dollar yen, we're looking at the S&P 500. Let's see what we got. Okay, let's get rid of that. Okay, let's get TICKSTRIKE up and running as well. But as I said, looking for at least a 0.2% deviation from the data, going in either direction, up or down. Looks like markets want to try and react beforehand. Okay, there we go. Okay, 3.7%, 3.7% higher than forecast, or 3.6%. CPI month-on-month, spot 4%, spot 4% higher than the forecast, spot 3%. Core year-on-year, as expected, at 4.1%, 4.1%, and core month-on-month, as expected, at spot 3%, as expected. Jobless claims, lower than forecast of 209k. Excuse me, initial jobless claims at 209k, lower than the forecast of 210k. Let's have a look. Okay. All right. So data. We're seeing that initial reaction there. We'll see how it does with if it does what it did last time. You had the initial market reaction, and then it flipped. Well, it didn't completely flip, but the initial market reaction didn't last that long. Okay, let's keep an eye on still some selling momentum there. Okay, from the data. Let me do initial market reaction measurement for this on the S&P. see how long it's going to last. So about 39 ticks down on the S&P. So that's not as strong as it was. No, wait a minute. I think it looks it's quite similar, to be honest. I just looked at it. Okay, so yeah, no, it is much weaker. This market reaction, the initial market reaction that we had seen from the data. So last time around, as said, the initial market reaction on the S&P was 69 ticks down. And then after about 10 minutes of trading, it was down by 19. So there was a reversal within that time period, but not a complete reversal. So we'll see how long this kind of lasts. But probably that's about 47. Okay, let's see how this goes. So 47 is the most. Right. Right, let's do a measurement on the dollar yen. I can't see what, hold on. There we go, now I can see. I can see clearly now. The ticker's gone. Okay, 31 pips towards the upside on the Dixie. On the dollar yen. Apologies. Okay, so still selling momentum there. Let's look at gold too. We'll also look at Bitcoin as well and see what how much Bitcoin has moved. Okay, 39 ticks on gold. Hold on. Oh, hold on. There we go. All right, there we are. About 13. Okay. All right. So this one seems to be a bit more sustained. Again, with the deviation, so it's a 0.1 deviation on the CPI data compared to the forecast, and on the month-to-month as well. But if we're looking at the prior figure, again, you can see that the data did come in lower for the core year-on-year and the month-to-month, besides the CPI year-on-year staying the same. But as I said, slightly higher than what the economists were expecting. Okay. And the core month-to-month staying as unchanged. Okay. So yeah, not as strong as the last market reaction that we had. So let me just review. So the last bit of data we had, it was the same. We had actually no, that included it was a different thing. But what I mean when I say the same, I'm talking about you had two figures that had seen a positive deviation, okay, or a deviation towards the upside, and the other releases didn't. They were as expected. So the market reaction, of course, you're looking at the core data that time round. So there was a stronger decline in the stock indexes. But this is just on the headline figures that you're seeing inflation tick up. But it is holding it though. All right. Also, don't forget to subscribe to the MACROACE mailing list. Now, for the MACROACE mailing list, if you are wondering how you get your hands on the deviations sheet, then all you've got to do is subscribe to the MACROACE mailing list here. Part of the MACROACE mailing list, what you get is you get the links to the live streams, and you also get the access or free access to the deviations Google Sheet that I've shared, or that you guys can see here at the moment. Okay. So that's there. So as I said, you can subscribe to that. It's completely free. You get to look at not only the CPI data for historical reference, but you can also look at the non-farm payrolls data, which I finished off making last week. At the beginning of last week. PPI data, a range of different economic releases. Some of the economic releases might not be up to date because they would have lost the traction or importance of how much or how big of a reaction that they would have. But there will be, you'll see that whichever release we will be covering, I'll be sending that out. I'll be you'll be able to see it in the email that I'll be sending out for you guys to have a look at. Miss Valerie says, I subscribed, but I did not receive access to the sheets. Okay, let me know. I'll have a double check. You should, yeah, so it will say deviations from that Google Sheet. It depends on when you subscribe. So usually I'll send out, if you subscribe today, you'll get an email Monday morning to be able to see the deviation sheet. What is going on, Alex? You didn't receive one either. Yeah. So okay. So Monday, every morning, double check your email if you haven't received my email. But yeah, so usually you should be able to see the two links, one for the live stream and then one for the deviations. And then there's a button that you've got to press, okay, in the email for the deviations. It's there at the top of the email. And then you should be able to get access to the link. You've been on the main list forever, but you haven't got one. How? How? That's strange. Is it not accessible? The email? Is that what it is? I'm yeah, because I test it every time I put it out. Yeah, it is a link. That's right. Yeah, crazy to eccentric. Nice name. Yeah, it's a link. In the header. So yeah, it's a link in the email. So let me hold on. Let me bring it up here. Let's see if we can try and bring it up for you. Actually, I got a way of doing this. Hold on, guys. I'm just going to show you. I'm just going to show you what you need to do. Okay. So, this here, okay, is what you would need, is what you would see, okay? So the ranges and deviations button, if you click that, that will then take you to the deviations and ranges Google Sheet, okay? So you should be able to see that there. So yeah, yeah, it's a link. You just found it? Yeah, so have a look at that there, yeah? So it's the ranges and deviations. Click on that button there, and then you should get the link. And then you'll be able to see it updating live in real time. You won't have to download like a PDF or anything. You can probably save it on your on one of your bookmark tabs if you want to. Yeah, if that helps. Does that clarify that for everyone? And for those who might have been subscribed to the MACROACE mailing list? I hope that does. Apologies if that didn't help before, but yeah, so I would say it again. So you get the email open up, it's the link there, and you just get the link to the MACROACE, the deviations, and also the live streams. If you click that there, you get the link to, of course, the YouTube live streams there as well, the playlist, so you don't have to keep finding the video each time. Okay, but yeah, there you go. So an example for anyone who subscribes to the mailing list today. Again, this is showing you how simple it is. There's not a lot of information that is included because I go through the information with you guys in the live streams. Okay, I like to keep it nice, short, and simple. So if your expectation is when you subscribe to the MACROACE mailing list that you're gonna, oh yeah, we're gonna get charts, and we're gonna get line graphs and all this. Nah, I keep it simple because it's nice to keep things short and sweet, and then go into detail with you guys in the live streams that I do for the upcoming economic releases. But the live streams will tell you which release I'm covering, and for the week ahead, and then of course you can find it here on the Google Sheet. You can kind of click through and find it. Okay, we'll see whichever one we're looking at. All right. So that is a MACROACE mailing list. I hope that's I didn't know that people weren't able to access it. I wasn't sure why. Now I know. But yes, it's a link, not an attachment to a Google Sheet. So what you might have to do if you don't have a Google account, make a Google account, sign in with that, and then you should be able to look at the deviations, ranges and deviations sheet if it doesn't let you look at it straight away. And then that's it. And then it's there for you forever free. Okay, so that's the deviations sheet, and that's a MACROACE mailing list. Okay, and as I said, so I send out an email every Monday morning for you guys to have a look at the week ahead. Now, FinancialJuice. So FinancialJuice is a live, real-time voice and text service providing you up-to-date news of what's going on within the markets, in geopolitical events, and what to be aware of what maybe there might be comments from central bank speak. Maybe Fed's Powell says something that the markets didn't expect, and it could be good or bad, and you might see the markets moving, but you're not sure why. It might be because of what somebody said or what has happened, like we have seen with the Israel and Hamas conflict that had obviously moved the markets. Of course, the news happened on the weekend, but when the markets had opened, it had caused the markets to have a huge move, and also the OPEC news as well that we had initially seen. Let me bring it up. Hold on. See if I can bring up the market reaction. So here we go. So there's little bits of news like that. Putin's and OPEC Plus deal will likely be continued. He said that yesterday, and then we chart that data here on our news feed with a market reaction, so you know that bit of news has moved the market at that time. Of course, there is the fundamental bits of news, and then there is technical. So having a live voice and text service allows you to have access to that fundamental news in real time, okay, not delayed on like a Twitter feed or something like that where the news might come out 5 or 20 minutes later and then you're kind of having to process it. It's live in real time in one place, in one feed, for you to have access to. That is the pro version of FinancialJuice. Okay, then there is the pro version of FinancialJuice. There are no adverts that play. You have all your economic data here on the left hand side in real time. the text headlines in real time as well, the voice feed here, okay, which I've just clicked on. You should be able to see me using the scroll bar. That's where the voice feed is played from. That also in real time as well, all in one place. That's a pro version. Now there is, if you haven't joined up to FinancialJuice at all, then what you would initially get is the Lite version of FinancialJuice, which has adverts that play every so often, advert banners. The data or the site is delayed as a whole for the Lite users, and you don't have access to the news desk to be able to ask us questions as to what's going on in the markets and why the markets are reacting in that way. Okay, that's a live version. But let me put it in a better way. So if you want to, if it's the first time you're listening to or getting acquainted to a live voice and text service, use the live version first. Okay, see if it's something that would benefit you, if it can work as part of your trading strategy. If it doesn't, then fine, but at least you wouldn't be taking risk of paying for it, and you'll be able to then know whether it's something for you or not. And then when you are ready to pay for the FinancialJuice service, then make sure, of course, if you already have an account, then you will see like a little button that says like GoPro here, where I'm kind of moving the little clicker here around there. Select your subscription, and then once you've selected your subscription, log out and then log back in, and then you'll see the pro version of FinancialJuice as you see it here. Okay. Does that make sense, everybody? Let me know if that doesn't, and I'll go over it again. But you probably don't want to hear me go through another advert about FinancialJuice. that's a bit too much. All right. So let me provide the link to FinancialJuice, so then you can have a look at it for yourself. Remember, just take it at your own pace. It's totally up to you. Whenever you're ready, you can sign up to the pro version of FinancialJuice. But again, if you're getting used to it, then use the live version. And once you're used to it and you're happy with it, then you can decide to have a little look at the pro version. Or if you want to go to the pro version straight away, make an account first on the live version. Okay, verify your email, then go back to the FJ FinancialJuice newsfeed, select your subscription. Once you paid for that, then log out and log back in, and then you'll be pro. Okay, that should be the verification process. So finally then, a couple of points. So we're looking at TICKSTRIKE here. TICKSTRIKE, so if you're unfamiliar with what TICKSTRIKE is, it allows you to listen to order flow and look at order flow within the markets. Or another way to put it is it shows you how strong the buying or selling momentum is within the markets. Okay, so here we're looking at the stock indexes, we're looking at the S&P here, and this number represents the strength of the buying and selling momentum. So a plus symbol shows you the buying momentum, and then vice versa with a minus symbol shows you the selling momentum. Okay. Then another thing we need to want to talk to you about is the reason why there are numbers is that you have this slider here. Okay. This slider represents the sensitivity of the ticker. Now the ticker sensitivity, okay, if you kept it at 1, that's the most sensitive to market reactions. So when there's a little bit of buying or selling momentum that occurs, then TICKSTRIKE will go off here. Okay, and if you drag that all the way to 15, of course you can chop and change wherever you want it to be. 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that occurs will TICKSTRIKE give you a visual and audio alert. Okay, visual with the colors popping off here. And then audio, of course, you can kind of choose whatever you want it to be from the options. But TICKSTRIKE is there. So then you, again, if you're particular for you, for the day, this is made for day traders for TICKSTRIKE. Okay, showing you how strong the buying or selling momentum is within the markets. That's what TICKSTRIKE is there for. So another thing, if you like scalping the markets, this is a new feature actually for TickStrike. This lightning bolt, okay, you click that. The lightning bolt represents even every single little move that's going on. Okay, so it is uber sensitive to the buying or selling momentum within the market, much more so than if you didn't have the lightning bolt on. Okay, so this represents 15 levels below 1. So if 1 is the most sensitive to market reactions, then you go 15 levels below that, and it is uber sensitive. And as I said, it's more for scalpers within the markets looking to capitalize on those opportunities here and there. But of course, you can kind of chop and change it as to what you want it to be and what makes sense for you. But again, that's the lightning bolt feature. So it's too crazy for me to handle, to be honest. that's not my thing. Seeing it going off all the time. But yeah, so let me post that here in the link for the chat. Yeah, right. Yeah, so that was, that headline there. US short-term interest rate futures fall after the CPI report. Yeah, so that you can see there. Is as soon as we get the news, bam, it is out on the news feed there for you to have a look at. Okay, and of course, we've had it where short-term. I'm trying to remember now off the top of my head, but we've had it where if there was a headline for short-term rates, I think it was either they decrease expectations or increase expectations for a rate hike or cut for a rate cut, and then there was a bit of a market reversal off the back of that move, off the back of the headline. I failed to remember what it is. I'll have to look that up. But yeah, okay, there we go. That is TickStrike, and yeah. Also, don't forget you can subscribe to Unusual Activity. So if you like trading at high probability stocks, futures, FX, and crypto breakouts in real time, then you can do that here with this link. I think with system-wise, TickStrike is it's a downloadable bit of software, so it should be able to work on whatever you're using. From my understanding, so it should be fine. If it's not, then do email us at FinancialJuice at our support at FinancialJuice. Support at FinancialJuice is our email. If you do have any issues with TickStrike or any of the products that we have. Okay, that is the live stream for the week. And for the day and for the week. Thank you very much for joining me live. As I said, I hope you found the information useful. We did get a bit of we did get a different reaction where the reaction wasn't as strong, but it did kind of sustain itself for a bit longer than it did last time round for the CPI print. For those of you who have subscribed to the MACROACE mailing list today, you will get access to the MACROACE mailing list on Monday morning. You'll be able to see that there. And of course, from then on, you'll have free reign to be able to look at whichever release you want to look at. Of course, you won't be able to edit it if you guys edited it. If I gave you access to do that, no, that's too much. But yeah, so as I said, completely free, and you can use it. You can use the data however you want to use it. Okay, there's no sort of specific way. The way I explain in the videos is how I interpret it myself. But whatever works for you. If you've got a better way of interpreting the data, then let me know. It'll be really interesting to kind of see how you guys might interpret the data. Okay. So you can email me at tony@financialjuice.com. Let me put that in the. I promise this is the final link. After all I've said, there you go. So yeah, email me personally. Give me your feedback as well. as well on the live streams if you found them useful. If you didn't, tell me why, and we can improve on that and make it better and make it badass. Okay. All right. You guys enjoy the rest of your day. Thank you very much for joining me live, and I will see you guys next week.